Traders, how do you create an effective backtesting framework, and what all does it take to have that run properly? In this episode of the Independent Quant, we're going to go in fives. We're going to talk about what a backtesting framework is, 5 common mistakes that trader makes, step by step, a 5-step, step-by-step guide on how to build a backtesting framework, and 5 best practices that you can implement for your backtesting framework. So with that, let's get right into it. I'm your host, Luis. I'm the founder of the Independent Quant. And to get started, I am not a financial advisor. All trades you take are your own. This episode is for educational purposes only, and we make no guarantees of success or profits. So with that, let's jump right in. So backtesting, what is it? It's the ability to verify that the strategy that you want to trade, or the idea that you want to trade, is actually effective in the market. Now, effective not just means profitable, but also that it adheres to whatever risk management rules and criteria and parameters that you've set for your account. So how do we go about that, and why is it important? Let's start with why it's important first. So like I said, make sure that the risk management and the profitability is there, but also the big psychological reason to do backtesting is that it helps you gain confidence in the strategy that you're testing. So I've mentioned how you may have the tendency or the urge to want to supervise your algorithmic strategy, which is not really the reason why you coded it anyway. So having that backtest allows you to gain confidence in that strategy so that you can supervise it as you should, rather than interrupt it when it's trading, not really knowing if it's the right time to be implementing that strategy. When should you take that strategy off? A lot of that will be answered just by way of backtesting. So what are the 5 backtesting mistakes and how to avoid them? So the first one is look ahead bias. This is when you have a strategy and you're backtesting it, and the way it's supposed to work is that when you're building a model, you have data that the model is built off of the testing that you're building. When you're building a model, you have data that you're using to build that model with, the training data. That data should be separate from the data that you're going to use to test whether whether that model is effective or not. Now, with look-ahead bias, what's happening is some of that test data is getting creeped into the model in training mode. Whatever way your model that you're using is being designed, that's creeping in somehow. The problem with that is that the model now sees the answer to the question, so it trains itself too well. That's not a feature that it's going to be able to do in the markets, because when it's live, naturally, it's not going to know what the future anything that is that you're modeling, be that if it's price or a feature of some kind. So look-ahead bias is something that we need to keep a look at. It's something that's fairly easy to overlook. You have to make sure that you're going in and ensuring that it's only looking at the data that it needs to be trained on. Some of that may be just looking at the logic you're using and how it's pulling the data, but you just have to take steps to make sure that look-ahead bias isn't a factor. The second one is survivorship bias. Now, survivorship bias is really a factor that happens when we look too far back in time. We could have a strategy that you test, let's say over the last 10 years, and you think this strategy is absolutely amazing. It has returns that are twice the market or whatever it is that you're finding. The problem with that is that businesses go out of business. They fail. And what's left, let's say in that 10-year period that you're looking, are those companies that survived and are still in business and were successful throughout that period of time. So that's where survivorship bias comes from, which you're in essence just looking at all those data points that were to be successful. Now, that's not going to translate as we go forward, right? You may be choosing the pool of losers that won't be around in the next couple of months or years, but you can't tell that simply by price action or anything that's going on today. So survivorship bias, it's really more a factor when you're taking too much history into account. The way to more easily combat that is be more sensible as to how far back your backtest goes. The strategy that you're using should be reflective of what you think market conditions are now or what they could be into the future. So there's a little bit of predicting there, but ultimately you don't want to go so far back that you are incorporating data that is just not applicable or that your model just isn't going to benefit from having. Check where you think the market is. Don't go too far back in time, and that'll help alleviate survivor bias. The next one is overfitting to historical data. Now, a very close relationship here to look-ahead bias. Not so much because you don't need look-ahead bias for overfitting, but it's the same nature in where now the data is, or your model is getting so well-tuned to the data that it's really only really good at predicting the data that it's been trained on, right? It can't actually be generalized enough to be taken out into the market and have new data introduced to it, because now it fails when it sees new data. And that's because it was overfit. It was overly trained to very specific conditions. The way you do that, or the way you avoid this problem, is usually simplifying your strategy is the first one. If you have too many parameters, potentially removing some of them. Some of this is also happens through over-optimization. So you have a strategy that you've continuously now updated multiple parameters over and over again. That doesn't really help. There comes a point of diminishing returns, and there comes a point where that model really just starts modeling the sample, right? The data that you're given it, that historical data, as perfectly as possible, which is counterproductive. Because again, you want that to be generalized to the point where new data comes in and it can predict it effectively, right? And model it effectively. So that's how you combat overfitting historical data. Next is ignoring trading costs and slippage. Now, depending on the brokers you use or the data sources you use, there's going to be varying different data costs associated with it. I'm not really going to delve into how complicated and how varied that could potentially be. But usually, you want to take a look at what those costs are, because you can have a strategy that appears to work beautifully with both profitability and risk management, but the moment you implement the costs associated with that trading, it can implode. And what costs are we talking about here? Well, it really depends on the brokers that you're using and the instrument that you're trading as well. If you're trading something that has spreads, you want to be able to factor in those spreads as best you can. If you're using a product that has commissions, such as futures, you want to understand what those commissions are and apply that to the trade, understanding that you're going to probably be paying that commission either per contract and both in and out of the trades. These costs can stack up really, really quickly. So that's why we want to consider them into our model. For slippage, that is when more prevalent when you have a market order, which is you are intending to get in at a specific price, but you're getting in at a much different price than what you'd hoped. Sometimes it works in your favor, sometimes it doesn't, right? And it's those times when it doesn't that we're really most concerned about. So we want to factor in for that as well. The beauty about including trading costs and slippage is if you're using your broker's platform, most broker platforms that I've worked with, which this podcast isn't sponsored by any, but I'm going to mention here, the ones that I have personal experience with is TradeStation and NinjaTrader. Both of them have the feature to be able to add the trading cost to that, as well as include some slippage, right? And how much slippage do you need? That's going to depend on the market that you're trading and really the symbol that you're trading. The less liquid that symbol is, the more slippage you need to include into your numbers to make sure that your strategy is sound and can really pass the test when it goes live. On to our last mistake here that traders commonly make, and that is using low quality or insufficient data. Now, there's an opposite to this, which is using too much data, but let's talk about low quality or insufficient data. You should use data that is what your model is ultimately going to see. For example, if you don't want to download data from Yahoo Finance and then train a model on that you're going to run either on NinjaTrader or TradeStation, you would imagine that all the numbers would be the same, but you'd be surprised how that's not the case. So that's one thing that of low quality data or data that maybe not up to snuff. But when we get a little more advanced, we start using alternate data sources, which I've talked on other podcast episodes, which is where we're not just using market data, but we're using maybe social media data. We're using very advanced satellite imagery. There's other data sources that you can implement into your model to hopefully make it better, right? That's why we do it. But if that data is misinformed, coming from data sources that aren't scrubbing their data very well, that can have adverse impacts on your model, right? Insufficient data, that one's a little harder to gauge as to how much data you need, because that's judgment call on your part given the strategy that you're developing. But you want to make sure that you have something that is statistically significant, right? You don't want to go too thin on the amount of data that you have. And for that, I'd really just recommend that you all go out and just have a good basic understanding of statistics and what makes a model. And that will help address that. That topic is too broad for me to be able to address on a single podcast episode. Just understanding that insufficient data is something that you need to overcome. Just ask yourself that question: is my data good enough, and do I have enough of it? So those are the 5 big mistakes. So now that you're aware of them, how do you now start building a backtesting framework, right? Well, here's a 5-step process for you to do that. The first one is define your strategy. They're always going to start here. Now, there should be a define your objective, but that's going to be for actually building an entire strategy and all that, a framework to test the strategy. But once you define your strategy, that's going to inform what your entry and exit rules are, what your position size rules are, and most importantly, what your risk management rules are. Once you have that defined, then you're going to ask yourself, well, what data do I need in order to execute this strategy? And that takes us to step 2, which is the actual gathering of that data. Multiple ways you can do this. There's a lot of free sources across the internet that allow you to get end-of-day data. Usually end-of-day data is free, even within a platform that charges for data fees. If that works for you, is you're using a swing trading strategy where you don't need intraday data. Intraday data is data below the daily time frame. So that's like 1 minute, 5 minute, 10 minute, 15 minute, 1 hour, 2 hour, anything that's inside of a day. That's intraday data that you'll probably have to reference a broker or some type of data source in order to get that. Many brokers allow you to connect to their platform programmatically via an application programming interface, an API. So that's a way to kind of get that done. The easiest and simplest to achieve that, though, is to use your broker software. That's if you're at the beginning of your algorithmic trading journey, your quantitative trading journey, that's where I'd start. And that's where you see a lot of our courses here. And the first few videos that we're making on the Independent Quant revolve around is that using your broker software. Now that you have your data, what do you do next? Now it's time to start developing that backtesting engine. And I'm going to talk first on actually developing your own, and then a way that it's kind of already built in for you. But if you want to develop your own, now you're going to want to know what programming language you're using. By this point, you should already know that because you're developing a strategy with that, right? So using the strategy, using the language that you've chosen, let's say it's Python, it's by far the most prolific language being used today. A lot of data science models are done on Python, be that machine learning models, large language models. All those libraries exist for Python. Along with those libraries, though, there are backtesting libraries available for you to use. And it's good to start looking at those libraries. Backtesting libraries Python include Backtrader and Zipline. Those are good libraries to take a look at and see if you can use those to backtest your strategies that you've coded in Python. Other languages have libraries associated with them. But the most simplest way to go about this is to, again, use your broker software. This could be your in-house backtest trading engine ready-made. The backtest, that engine that the platform uses, they vary from one to the next. For example, the NinjaTrader backtester is very different than the TradeStation backtester, but there's usually enough documentation for any platform for you to be able to look that up and just get very familiar with that broker software as far as how does it backtest, how does it look at data when it backtests, because you just pulled all this data and gathered all this data to model it and execute your strategy. But the way your platform goes about actually analyzing that data and then compared to how it executes when it goes live can be night and day. So you just want to become very familiar with how your backtesting engine works if you're using a broker a broker developed one. And that actually holds true even for the Python ones or any other programmatic language. You want to become familiar with each one of their backtests and how it actually manipulates data and how it manages orders and how it places them and how it identifies signals, because that's going to be critical for you in order to make assessments as to how well it's all working. So now you've got your backtesting engine, it's time to go to step 4 and actually start running those backtests and analyzing all the results that are coming out of it. I've gone through other episodes where I've discussed the metrics that you're looking for to see what a good backtest is. One that newer traders usually gravitate to is win-loss percentage. Just remember that your win percentage is dictated most by the type of strategy that you're using. As an example, if you're using a trend following strategy, if you're getting a 40% win rate, that's pretty good. Anything below 30% is you need to take a look at it, but that's still a pretty big percentage. You're still talking about being wrong 6 to 7 times out of 10. If you've got a strategy and it's winning 50% of the time, that may sound good, but something may be up, right? Because that is above what a typical good trend following strategy provides. In contrast, if you had a mean reversion strategy, those tend to be much higher, above 60%. If you have a low win percentage or a really high win percentage, you want to take a look at it. So you want to know the parameters or the variance for the type of strategy that you're using. You want to take a look at the max drawdown. The max drawdown is going to inform you on how big an account size you're going to need to trade that strategy, right? You don't know when the max drawdown is going to happen. Yes, that's a number on the screen. The backtest will tell you when it happened, but that doesn't tell you when it's going to happen in the future. But it's a good figure to have in your mind that, hey, that could be, in essence, your max loss. That's not really a way to think about it, but because it sounds like it's verifying that it's going to do that. That's not what I'm saying. If you know that your max drawdown for a strategy is $40,000, let's say, given whatever period of time you look back into, you can pretty much guess that, hey, you're going to need definitely at minimum $40,000, but if you're smart, then obviously not. It's going to be a multiple of that, right? You're probably going to need $50,000, $60,000 in order to execute that strategy. Truthfully, you're going to need maybe a 2-3 time multiple of that to really be comfortable and safe. But that's a judgment call on your part. But you know for sure you're not going to need less than the max drawdown. That would be unwise. But next, you're going to start looking at your profit factor. What's the size of the winners compared to the losers? This is usually expressed, in as a decimal, 1.5, 2.0. The larger, the better. The larger those are, though, the harder they are to achieve. But you, depending again on your strategy, is going to dictate what that profit factor should be within. If you're in the 3-to-1s on a trend following strategy, that sounds about right. If you're at 1-to-1, even if you have regardless of what strategy you're having, you really need to take a look at that, because anything below a 50% win rate is going to cause you to just destroy your account. So that's another metric that you need to keep an eye on. And with that, we end with trade expectancy. That is how much expectancy, how large do you think your winners are going to be over the course, or the expectancy for that strategy over the course of time. And that's a calculation based off of your average winners and average losers compared to your win percentage and loss percentage. You want a positive number there. The larger, the better. But just like anything in life, getting it to be higher is going to be a challenge, right? So that rounds out step 4, running the backtest and analyzing the results. Now, the last step here is step 5, performing out of sample testing. To ensure your strategy wasn't overfitted, you want to take a couple of steps to make sure that it is operating within parameters. That is, you can do that by testing it in different market conditions, see how it performs there, using the backtest as well, not taking it live, but then seeing how it performs on other assets and time frames, right? Even if it's not profitable in other time frames, that's okay, and other assets, that's okay, because you're not looking for its profitability or not. You're trying to see if the logic is working right. If the logic is working right and it looks like it's capturing the appropriate amount of data as it should, then you can feel more confident that when you put on that one symbol at the one time frame that you've been backtesting all this time, that the logic is actually working appropriately and giving you the results that you expect even when you take it live. So that's the 5-step process to get to building a backtesting engine. So what are the 5 best practices to get a good, accurate, and reliable backtest? So first things first is using realistic execution models, and that's taking into account all those mistakes that I mentioned, counting slippage, counting costs, making sure that your metrics for the performance of your strategy are comparable to the type of strategy that it is. Next is you want to account for changing market conditions. So understand what type of market you tested that strategy in and what market conditions are now, or what you expect them to be in the near future as you deploy the strategy. Because if you don't account for that, you may have trained your market strategy in a market that was rallying and now we're in a bear market. Well, it's an opposite trend, so maybe it will work out just fine. But what if we're ranging? Now that's not really going to work very well for you if you have a trend following strategy. Now, the next step would be to validate across time frames. Again, this is just like the step 5 that I mentioned earlier. This is usually when you train a strategy, it's usually conditional to one time frame and one symbol because of the dynamics that are happening in that time frame or symbol. But it's good to test it across other time frames just to verify, hey, did I choose the best time frame for this? Sometimes you'll see that you may do better in a lower or higher time frame. But also you want to do this because you want to verify what the general trend of the market is. This is, I think, becomes more critical as you go lower in time frames for the strategy that you're going to be executing on, because you may be very successful thinking, hey, I've got this great bull strategy that's, taking all these, the strategy I've got is winning predominantly any time it goes long. Well, if you zoom out on your time frames and you notice, hey, overall the market that you're trading is in a downtrend, you just happen to have been trading or backtesting in what's a pullback where it's running back up. That's great, but how long is that pullback going to exist? It's showing great on the intraday, but if the larger pressure continues and the market continues down, your strategy kind of goes out the window, right? It could, depending on if it's not accounting for short trades or is performing worse on short trades. So validating across time frames gets you that, and it helps you see the bigger picture. And then stress test for worst case scenarios, right? You want to see what would happen if you get disconnections, if you see bad news coming up in the near future, and you don't know when bad news is, but significant news, right? If you're trading during a period of time where there was no Federal Reserve news and there was no big economic reports, that's going to be a lot different than if you are going to run that strategy through earnings season, through all those big reports. You're going to have to stress test that, make sure that you know whether or not to keep the strategy running through those time periods or if it's even viable for you to have it on. The last one here is to regularly update and optimize, and I can't stress this enough. Markets change. Just because you trained this model to execute a strategy for you under present conditions, or it doesn't mean that it's going to continue to work that way, because the market's going to shift. It's going to change. It's a living, breathing thing because it's run by living, breathing people, right? It's a reflection of the aggregate greed and fear that's in the world and in the market that you're trading. So you want to make sure that you're taking all of that into account. You want to go in there and update the metrics that you've set, or update the parameters that you set, so that you can get the metrics that you want, and then make sure that you're optimizing your strategy for the present market conditions. So with that, we talked about the many 5 steps, from everything from how to construct a robust engine to a step-by-step guide on how to build one yourself or use your broker's platform, and then what the best practices were for a trading strategy or a backtesting framework. With that, thank you so much for listening. I look forward to seeing you next time. This is Luis. Keep it green. Out.